Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of a comprehensive guide to private equity investments. Risks and rewards of private equity investments. Private equity investments offer a unique mix of potential rewards and significant risks. Understanding these factors can help investors make informed decisions. Potential returns. When we talk about private equity, one of the first things that comes to mind is the potential for high returns. Historically, private equity investments have outperformed public markets over the long term. According to various studies, private equity funds have delivered average annual returns between 10% and 15%, while public markets typically yield around 7% to 9%. Why do private equity investments often have higher returns? Value creation. Private equity firms target companies that can be improved. They bring in expert management, streamline operations, and enhance sales strategies. Longer investment horizon. Private equity funds usually have a 7 to 10-year investment timeline. This allows time to implement changes and realize growth. Less market volatility. Since private equity firms invest in private companies, they are less affected by daily market fluctuations. These factors can lead to substantial gains for investors willing to commit their money for the long haul. However, higher returns often come with greater risks. Risks involved. Investing in private equity isn't without its challenges. Understanding these risks can prepare investors for what's ahead. Here are some of the key risks associated with private equity investments. Market risk. Economic downturns or shifts in consumer behavior can hurt the performance of portfolio companies. When the market struggles, even well-managed companies can suffer. Liquidity risk. Unlike stocks, private equity investments are not easily sold. Investors may need to wait years before they can cash out. If an urgent need for cash arises, having funds tied up can be a real downside. Operational risk. Private equity firms are often involved in the daily management of their portfolio companies. This includes making tough operational decisions. If these decisions don't pan out, the investment could lose value. Investors must weigh these risks against the potential rewards. It's essential to conduct thorough research and possibly consult with financial experts before diving in. Are you ready to uncover both the potential and the pitfalls of private equity investments? Key players in private equity. Private equity is a unique world filled with various players who each hold significant roles. Understanding these key participants helps clarify how private equity investments function and why they matter. Here's a closer look at the main players. Private equity firms. Private equity firms act as the backbone of private equity investments. These firms gather funds from various investors to invest in businesses. Their main goal is to buy companies, improve them, and then sell them at a profit. Investment strategies. Most firms follow specific strategies to choose companies. Some focus on buying companies that need improvement, while others invest in growth stage businesses. Regardless of their approach, the ultimate aim is to increase the value of their portfolio companies before selling them. Active management. Unlike other types of investors, private equity firms often take an active role in their investments. They may change management teams, improve operations, or expand into new markets. This hands-on approach is what sets them apart. Limited partners. Limited partners, LPs, are a crucial part of the private equity ecosystem. They provide the funds that private equity firms use to make investments. Types of investors. LPs can come from various backgrounds, including institutional investors. These include pension funds, insurance companies, and endowments that have large pools of capital. High net worth individuals. Wealthy individuals often invest as limited partners to diversify their investment portfolios. Family offices. These manage the wealth of families and look for private equity opportunities to grow their assets over time. Limited risk. One of the appealing features for LPs is their limited liability. They invest their money but are not responsible for the firm's debts or operational decisions. Portfolio companies. Portfolio companies are the businesses that receive private equity investment. They are the players that private equity firms seek to improve and grow. Significance. These companies span various industries, including technology, healthcare, and consumer goods. The goal for private equity firms is to find companies with potential for growth but that may need help to reach their full capabilities. Nurturing growth. When private equity firms invest in these companies, they often provide the capital needed for expansion, product development, or operational improvements. This support can lead to significant transformations in the company's performance. In a nutshell, private equity firms, limited partners, and portfolio companies form an interconnected ecosystem. Each plays a vital role in driving investments forward and creating value. Understanding these players helps clarify how private equity operates and why it is an essential component of the financial landscape. Future trends in private equity. As the world of private equity evolves, several trends are emerging that will shape the future of investments. These trends reflect changes in technology, growing awareness of social responsibility, and shifting market dynamics. Understanding these trends can help investors stay ahead in a competitive landscape. Impact of technology. Technology is not just a tool, it's a trend that is transforming private equity operations and investment strategies. Today's investors have access to vast amounts of data. This allows them to make better decisions faster. For instance, artificial intelligence can analyze potential investments much quicker than ever before. Instead of spending weeks on due diligence, firms can now evaluate hundreds of opportunities in a fraction of the time. Moreover, tools like blockchain are bringing more transparency to private equity. This technology helps parties verify transactions securely and at lower costs. It can reduce fraud and improve trust among investors, leading to more successful partnerships. With the rise of digital platforms, even smaller private equity firms can compete with larger players. They can reach investors and startups that were previously out of reach. This democratization of access opens the door for innovative ideas and diverse investments. ESG considerations. In recent years, environmental, social, and governance (ESG) factors have gained significant traction. More investors are prioritizing investments in companies that not only promise financial returns but also adhere to ethical practices. This trend reflects a broader societal shift toward corporate responsibility. Investors are asking questions like, how does this company impact the environment? What are its labor practices? How diverse is its leadership team? These factors are not just about meeting standards, they can directly impact performance. Companies that ignore ESG considerations may face backlash, poor public relations, or even legal issues. Investors are realizing that good governance and social responsibility can lead to more sustainable, long-term growth. Market dynamics. Current market dynamics are shaping the private equity landscape in real time. Increased competition is one of the most significant changes. More firms are entering the space, leading to a crowded market. This can drive prices up and reduce the availability of high-quality investment opportunities. Regulatory changes also play a critical role. Governments worldwide are tightening regulations on private equity and investment practices. As a result, firms need to adapt quickly to ensure compliance. This increasing scrutiny can lead to additional costs but also presents an opportunity for those that can navigate it well. Investors must stay alert and informed about these dynamics. Understanding market shifts will help them make better investment choices. The key is to remain flexible and open to change. These trends show that the future of private equity is dynamic and multifaceted. By embracing technology, prioritizing ESG factors, and staying aware of market dynamics, investors can position themselves for success. Keeping an eye on these developments will be crucial for anyone looking to thrive in this challenging environment. Private equity investments offer significant potential for growth and high returns. They allow investors to take part in the transformation and scaling of businesses, often leading to impressive financial gains. As you've seen, thorough research and due diligence play a crucial role in ensuring success in this arena. Consider exploring private equity as an investment option, especially if you're seeking to diversify your portfolio. What sectors excite you the most? Your insights can spark engaging discussions in our community. Thank you for reading, and I look forward to your thoughts on this dynamic investment landscape. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.